next presentation is going to be delivered by George, who's the co-founder at BWM Value Investing. BWM Value Investing is an asset management company which was set up in 1997 with the goal of achieving very good long-term returns for investors, capital appreciation, and they have a value style biased. They've managed to surprisingly outperform the benchmark for the very long term since inception for around 2% per year. We've seen just a very limited number of managers all over Europe who've been able to do that, and that's why they've received the recognition of the AAA rating by Tenvalue. We thank them. Thank you very much for joining us today, and yes, he's one of the best, also as the other who came for many years in the market, and I'm looking forward to listening to you.
Well, thank you very much. Do I need to do anything, or?
Yeah.
So, well, that was the key slide, so now you've seen everything. Okay, so I'd like to introduce our firm and how we work quickly. We're value investors. We manage 2 funds, and what we do is value investing, because that's what we do. We're value investors. So we're fundamental value investors. We look at the companies very carefully. We are stock pickers. I'll talk about that quickly. I'll give you an illustration of a typical holding. Sonai, it's a Portuguese conglomerate. And then I'll give you just a little marketing pitch about how wonderful it is to be a value investor today, even though it hasn't been wonderful for the last few years. So how do we work? Well, as I said, we manage 2 funds. The Classic Global Equity Fund was founded in 1997. Classic Value Equity was founded in 2004 because we had to soft close the Global Equity Fund at the time. They both do essentially the same thing, but the Classic Value Equity does not invest in small caps, which we define as companies with a market cap of 2 billion francs or less when we buy the first share. What we're trying to do is put together a portfolio of 25 to 30 stocks by understanding the businesses carefully and buying them at a discount. So we're looking for a high margin of safety based on normalized figures. I'll go into that in a second. We're engaged investors. That is, we talk to our companies. We write them letters sometimes if we feel like that's necessary. So we're very close to them on every level. Now, how does what do I mean by normalization? It's quite simple. We tried. Well, it's a long process, but theoretically it's simple. We study a company's history and its competitors' history to know to get an idea of what the normalized level of earnings is. Typically, a value stock is cheap for a reason. It's usually under pressure because something's not going well. It's not earning as much as it should. So you want to know how much do they earn under normal circumstances by studying its history, by looking at the competitors. That gives you an estimate of what's possible in the future. And then we say, okay, let's say that we go back to this normalized level. If we think that's going to happen, what would be the normal multiple? And again, you get that by studying the history, doing a discounted cash flow analysis, all of the basic tools that securities analysts use. Mechanically, we say in 3 years we reach normal earnings. In 3 years we reach a normal multiple. Then we discount that intrinsic value back to today. And that's what we think the stock is worth today. And then we buy at 60 cents on the dollar, roughly. Sometimes we pay a little less, sometimes more. Depends on how risky the situation is. The heart of the process is research. Most of what we do is research. We do building our own financial models, talking to the companies, talking to competitors, to ex-employees. The idea is to get a good sense of what the numbers that you're looking at mean. The numbers are the starting point, but you want them to tell a story. You want to know the story of the company. And you can only get that by understanding what people have experienced, what has gotten us to those numbers. And then we value each company in the process I just described. Here's our performance of the Classic Global Equity Fund since inception. So you see we had a wonderful phase which ended about 10 years ago. It's not been a fun time to be a value investor. We've been going sideways, but as I'll show you at the end, I think that's going to change soon. Let me give you an example of how we think. I'll skip some of the slides because I don't want to go into too much detail, but the company is Sonai. It was built by the De Azevedo family. The patriarch, who's now out of the business, bought the company in 2000. All it did was wood panels at the time. He then diversified it. He did what you're not supposed to do, buy lots of different businesses. And in the meantime, this chart shows you what we think is the intrinsic value of the various bits of it. You've got retail, you've got electronics, you've got real estate, you've got telecom. This is one of the largest companies in Portugal. It's the largest employer in Portugal. And they have their fingers in a lot of pies, but they're good at it. Their main asset is Continente. That's the largest supermarket chain in Portugal. This is the best supermarket chain from what I understand. It's got the best selection, it's the freshest products, it's got the best distribution, and if you have a loyalty card, it also has the best prices. You pay less here than you would at Lidl for your groceries. So it's a very successful company. Show you that with a couple of charts. It's been growing at 7% per annum. Since 2013. That's very good for a supermarket. We'll see that in a minute. And its margins, EBIT margins, are at about 5%. How does that stack up to the competitors? Here you've got all the names that you know. Sonai is the solid line, and then the dashed lines are the various competitors. And you see that it's been growing very, very well, considering that this is all organic. Here we've just taken the sales of the competitors, so any M&A that they've been doing would also make those lines go up. So this is a growth business, also because, of course, Portugal is a growth economy. The margins in international comparisons are really good. Actually the best at the moment, normally one of the best, showing how well managed this company is. Okay, now what's the key then over the long term? For us, it's the value creation, that they make money with this thing. So let's just take an increase in book value of Sonai. Now we're back at the entire conglomerate, right? Book value's gone up nicely, but if you do a Buffett return on equity, which is you take the change in book value plus the change in, and you add back the dividends that have been paid out, you get that they've posted a 9% annual return for the last 15 years. 9% is pretty good. It's not great, but it's good. And this is just the book return. Obviously, there's going to be value created on top of that. How do they do it? Well, they run it well. I showed you that. And they're also good asset traders. They just sold 25% of Continente, which would be MC Sonai. That 25% gives us an implied valuation for the 75% they still own, which is larger than the market cap of the company on the whole. So you're getting all the other assets for free. But they do a lot of transactions, so they're good operators and they're good asset traders. And here's the valuation. Here's the price to book ratio from top left to bottom right. Now the way we work is we give every company an intrinsic value, that's the solid line. Then to give you an idea of the contingency of corporate earnings, we also estimate a high and a low value, makes us as analysts aware of risks and opportunities. And you see that Sonai has been trending sideways even as it's built value over time. So it's one of those situations that hasn't worked out. This has not been great for performance, but it's wonderful value creation, which as an investor is where you want to start, because you know that eventually the market will catch up. And I think it will catch up because stocks in our part of the universe, cheap stocks are really, really cheap right now, especially in Europe, where we're about 80% invested. On the left, you have the MSCI indices for growth and value in the United States. On the right, Europe. In blue is growth, so expensive stocks. Green is the is value, and in every case, we're showing you the PEs, the forward PEs. And you see how the US is very expensive on the growth side and is kind of expensive on the value side. Here, Europe as well, you've got a big gap between growth and value, a gap that's much larger than what you used to have. But value stocks have gone sideways in terms of valuation. And that says to us that this is a wonderful opportunity. Another way to look at this is to have the ratio of large and small caps PEs. Again, on the left, United States, on the right, Europe. You see there's an enormous gap between expensive and cheap, 2 standard deviations from the mean. You know that's not sustainable. All of us know that mean reversion is ultimately what drives a lot of the financial markets. So with all that said, a quick look at our portfolio. Just to show that we really are value investors. This is our estimate of price to intrinsic value for the portfolio as it stands. So if we're right on all of our companies, you're buying them at 55 to 60 rappen on the franc, 60 cents on the dollar. But if you don't believe us, if you think that these numbers are made up, here's the Bloomberg numbers to prove, just to show you where the multiples stand as an average for the portfolios. And you see that we're about half as expensive as the MSCI in terms of PE, and less than half in terms of price to book. And at the same time, you've got high dividend paying stocks, which is tax inefficient and not something I like, but it is an indication that these companies are healthy and unfairly cheap. That's it. As far as our presentation goes, if there's any questions, I'm happy to take them.
Can you trace back your value approach into how it was first created? You know, there is this Columbia University, Graham and Dodd, Warren Buffett type of view. How do you form your own philosophy? How does it compare to the classical value?
Oh, I'm sorry, I don't quite understand the question. How does our approach differ from the classical value?
Exactly.
It is classical value. It's very boring.
No, but for example, you look at same as secret sauce, or actually more like what type of company you look at, as opposed to.
Well, we avoid certain businesses because we don't think they're very interesting or very good. So you want to look at capital returns over time. But we're not, I'm not going to say we invented anything. We didn't. But our style does. We do avoid certain bad businesses if we think that over time they're not going to create value. And of course, the basis of the valuations is the cash, the ability of the assets to generate cash. But sometimes that, let's take a building that's not rented out, its ability to generate cash will be if it can be rented out, or if it's demolished and something better is built in its place. So but ultimately you want to know how much cash something will generate because that's what we're paying for as investors. Everything else is, that's why gold is not interesting for us.
There was another question.
One question. These Portuguese companies looks very interesting. What's the main reason why you believe it's so cheap?
Yeah, that's always the hardest question. Why is it cheap? Because you look at it and you say to yourself, this is stupid. Well, I guess there's a couple of factors. Number one is it's in Portugal. And who invests in Portugal? Number two is it's a conglomerate. We all know that conglomerates are bad. Yeah, that's probably it. I mean, it takes a little bit of work to understand it. It's not that big. So if you're going to spend a lot of time taking apart a conglomerate, then I suppose you'd rather do a really big conglomerate. On the other hand, it's a European company, so you have good disclosure, not like in America, where the disclosure is terrible. Yes?
I think you said you were trading on the sideline and you were expecting this to change. Been painful to be a value investor, and you expect that to change. What do you see in the environment that will build the case for value investing?
I guess if the factors that have caused value to suffer for so long were the super low interest rates. So that's over. We're back to normal interest rates, even though most young people don't know that for them that this isn't normal, but for old people like me, this is normal.
4 is even low still.
Huh?
Still low 4.
Yeah, maybe even a little bit low. Whatever, but basically we're talking about a normal level of low to high. It's not crazy. That's that. Then there's the trend to passivization. It's sucked a huge amount of assets out of our investment style, out of active value investing in particular, because it's underperformed as a style. It's a salesman for a U.S. value company said, I go to the young guys, they know that value is dead. It's never going to come back. Forget it. It's over. And we've had huge outflows over time. That's forced us to sell value stocks, which caused those to underperform. It became a vicious circle. I think that's pretty much over. I don't think there's much less either that or we go out of business completely, all of us. But we're all fairly small compared to where we used to be. We're completely out of fashion. There used to be lots of books about value investing. When I was young, you read lots of books about value investing. Now they're all about quality growth investing. That's what's being published. Chancellor just had a nice presentation on that a couple of weeks ago here in Zurich. Everybody wants quality growth because we know that's what's the right thing to do. Value's out. And then the last factor is, what have I forgotten, Orban? The interest rates, the passivization.
Valuations effectively becoming cheaper.
Yes, that's right. The mechanics of value investing. The GMO took this apart for nicely. You've got, well, Orban, you explain it. It's your slide. This is my colleague Orban Müller. He used to work at GMO.
Okay, I'll go ahead. Didn't prepare for this, but that's okay.
You know it.
So basically, one thing you can do is you can do a return decomposition of any return, and if you do that, you basically have dividend income, you have earnings growth, and you have a multiple expansion or contraction factor that all adds up mathematically to total returns. You do that for value type stocks. What you realize is that the mechanics of value investing, the dividends are still being paid, the earnings growth isn't great, that you wouldn't expect that for value stocks, but that's continued. The one thing that you can really observe in the time series of US stocks and European stocks is that valuations of value stocks over the last 10, 15 years have continued to go down. It's been particularly pronounced in deep value, i.e. very cheap value stocks, where the main factor for its underperformance has been earnings multiple compression. And so we do think that there also some law of gravity will apply, and that multiples cannot basically compress forever. Now we should clarify that we're talking about value investing of which considers quality. We certainly don't ignore management quality and other aspects, but the value segment that's been doing particularly poor has really been the very cheap, deep value type of stocks that we like to fish for in our portfolios.
And it's what Urban was saying before is, for value investing to work, you needed to have cheap stocks become more expensive over time as people discover the undervaluations, and that mechanism has just simply stopped. And so now you've got relative valuations for cheap stocks versus expensive stocks that are just completely crazy by historical standards. And so I think that, I don't know, we've had craziness for a number of years. We'll probably have another 4 years of craziness ahead of us in America, in politics. God knows what'll happen, but it's probably a better bet. I would say if you're going to place money going forward, you have to put some money on mean reversion in this mechanism versus just betting that NVIDIA is going to dominate the world of AI chips forever. You know, it just doesn't make sense not to do at least some value investing nowadays.
Thank you.